There is one number quietly re-entering the conversation that could completely redefine the silver market, and almost nobody in mainstream finance is talking about it. Not a headline. Not a price target. A ratio. Legendary precious metals investor Eric Sprott recently made a statement that stunned even seasoned metals investors. Silver doesn't need hype, memes, or speculation to explode. It only needs history to repeat. Because if gold does what it has always done during currency stress, and if silver simply returns to its historic relationship with gold, then the math points to something most people are psychologically unprepared for. $300 silver. Not as a fantasy. Not as a bubble. But as a reversion. For over 3,000 years, gold and silver traded at roughly 15 ounces of silver for 1 ounce of gold. That ratio governed empires, currencies, and monetary systems. Today, that relationship is so distorted it borders on absurd, yet distortions don't last forever. They snap. And when they do, silver doesn't move slowly. It reprices violently. In this video, we're not going to hype silver. We're going to walk the math, expose why the paper market is losing control, and explain why this cycle is fundamentally different from anything we've seen before. Because when silver finally moves, it won't ask permission. It will reveal what's been broken the whole time. Who is Eric Sprott and why this call matters? When Eric Sprott speaks about gold and silver, markets listen, not because he makes bold predictions, but because his entire career has been built on identifying structural breakdowns before they become obvious. Sprott is not a trader chasing momentum, nor a commentator reacting to headlines. He is a capital allocator who has spent decades studying the plumbing of the precious metals markets, understanding how leverage, short positions, and physical supply constraints interact beneath the surface. As the founder of Spratt, he has deployed billions of dollars into physical bullion, mining equities, and royalty companies, consistently positioning himself where real metal, not paper promises, matters most. His credibility comes from being early, patient, and data-driven, often enduring long periods of being ignored before his thesis is ultimately validated by price action. What makes this specific call so important is that Sprott is not merely bullish on silver, he is reframing how silver should be valued in relation to gold. Over the past year, he has openly shifted his own portfolio allocation towards silver, moving to a 50-50 split with gold and, at times, even heavier towards silver. That is not a casual adjustment. It is a conviction-based decision made by someone who understands risk better than most. Sprott's $300 silver framework is not built on speculation or technical patterns. It is rooted in the historic gold-to-silver ratio, the accelerating physical supply deficit, and the visible stress in futures markets where paper contracts vastly outnumber available ounces. When an investor of Sprott's caliber makes a call like this, it signals that something foundational has changed. This is not about catching a trade, it is about recognizing a systemic imbalance that cannot be corrected quietly or gradually, only through repricing. The gold-to-silver ratio, a 3,000-year signal. To understand why Eric Sprott's $300 silver call is grounded in reality, you first have to understand the signal that has guided precious metals markets for thousands of years, the gold-to-silver ratio. This ratio simply measures how many ounces of silver it takes to equal the value of 1 ounce of gold, but behind that simplicity is a historical constant that stretches back over 3 millennia. From ancient Mesopotamia and the Roman Empire to medieval Europe and early American coinage, gold and silver consistently traded near a 15-to-1 relationship. This was not an arbitrary number or a government decree pulled out of thin air. It reflected the natural scarcity of the metals in the Earth's crust, their mining ratios, and their shared role as monetary anchors long before modern finance existed. For most of recorded history, whenever the ratio drifted too far from its long-term average, it did not stabilize gently, it snapped back. Extreme deviations have always signaled stress in the monetary system, whether through currency debasement, war, or debt expansion. What makes the modern era so unusual is not that the ratio has moved, but how far it has been allowed to stretch. In recent decades, the gold-to-silver ratio has blown out to 80-to-1, 90-to-1, and at times even beyond 100-to-1, levels that have no precedent in a system backed by physical reality. This distortion was made possible by paper markets, leverage, and the financialization of silver into a derivative rather than a material. Historically, when the ratio reaches extremes like this, silver does not slowly catch up. It violently overcorrects. Every major silver bull market, from the 1970s to 2011, was preceded by a stretched ratio and followed by a rapid collapse back toward historical norms. The ratio, in other words, is not a curiosity, it is a warning light. And right now, it is flashing again. Why this time is different and more dangerous. What separates this cycle from every previous silver bull market is that silver is no longer just a monetary metal reacting to fear, inflation, or currency debasement. It has quietly become a strategic industrial input that modern civilization cannot function without. In past cycles, silver demand was largely discretionary. Photography, jewelry, and investment flows dominated the landscape. Today, silver sits at the center of irreversible technological systems. Solar energy, electric vehicles, data centers, advanced electronics, and next-generation batteries. These industries do not speculate in silver, they consume it, permanently removing ounces from the market. Unlike gold, which is almost entirely recycled and hoarded, silver is used, dispersed, and lost. Once it goes into a solar panel or an industrial circuit, it does not come back. This is what makes the current setup more dangerous than anything seen before. Silver demand is no longer cyclical, it is structural. At the same time demand has become non-negotiable, supply has remained stubbornly flat. Global silver mine production has failed to meaningfully increase for more than a decade, and much of today's silver output is merely a byproduct of base metal mining, meaning higher prices do not immediately create new supply. You cannot simply turn on silver production. New mines take years, sometimes decades, to permit, finance, and build. So while demand accelerates annually, supply responds slowly, or not at all. This creates a pressure cooker scenario where the traditional release valves no longer work. In prior silver rallies, paper markets were able to suppress price by flooding futures contracts and shaking out weak hands, because there was always enough physical metal somewhere to backstop the illusion. That assumption is breaking down now. Industrial users are locking in long-term supply. Sovereign buyers are taking delivery. Investors are increasingly demanding physical metal rather than rolling paper positions. This is no longer a speculative squeeze, it is a material squeeze. And when a market shifts from being driven by sentiment to being driven by necessity, price does not move politely. It reprices abruptly, because the system has no other way to balance itself. The physical silver supply breakdown. At the core of Eric Sprott's silver thesis is a simple but deeply uncomfortable reality. The physical silver market is no longer balanced, and it hasn't been for years. Global demand for silver now exceeds annual mine supply on a consistent basis, creating a structural deficit that is quietly draining above-ground inventories. Unlike paper markets, where contracts can be created infinitely, physical silver is constrained by geology, energy, permitting, and time. Mining output has been effectively flat for over a decade, not because demand is weak, but because most silver is mined as a byproduct of copper, lead, and zinc production. This means silver supply does not respond directly to silver prices. Even a dramatic price increase does not instantly result in more ounces coming to market, leaving the system increasingly fragile. This fragility becomes visible when you look at delivery behavior rather than price charts. Large buyers are no longer content with cash settlement or rolled contracts, they are standing for delivery. Inventories at major exchanges and vaults have been steadily drawn down as physical metal leaves the system and does not return. Each delivery request tightens the available float, reducing the margin for error. The market only functions as long as most participants are willing to accept paper claims instead of metal. Once that confidence erodes, even slightly, the leverage embedded in the system becomes a liability rather than a feature. What makes this situation especially precarious is that silver does not need a total collapse to reprice, it only needs a marginal shift in behavior. If a small percentage of industrial users, sovereign buyers, or institutional investors decide that guaranteed access to physical silver matters more than price, the available supply vanishes rapidly. This is why Spratt consistently emphasizes physical ownership over paper exposure. The physical market is where the truth is being revealed. Paper markets can obscure shortages temporarily, but they cannot manufacture metal. When physical supply tightens beyond a certain point, price is no longer negotiated, it is discovered under pressure. Why paper manipulation is failing. For decades, the silver market was controlled not by physical scarcity, but by paper dominance. Large financial institutions were able to suppress price through concentrated short positions, sudden futures dumps, and leveraged contracts that bore little relationship to the actual amount of silver available for delivery. These tactics worked because confidence in the system remained intact. Most participants were content to trade exposure rather than metal, and as long as contracts could be rolled forward or settled in cash, the illusion of abundance held. Price could be managed because belief, not necessity, was the primary driver of participation. That dynamic is now breaking down. The paper market depends on one critical assumption, that the majority of holders will never ask for physical silver. Once that assumption weakens, the leverage embedded in the system becomes dangerous. Today, more buyers are demanding delivery, more contracts are being converted into real metal, and more ounces are leaving exchange inventories permanently. When paper claims multiply faster than physical supply, every delivery request exposes the imbalance. This is why the familiar smash tactics, large sell orders dumped during thin trading hours, are losing effectiveness. Prices dip briefly, but they recover quickly because physical buyers step in immediately, treating paper sell-offs as discounted entry points rather than warning signals. What has truly changed is who the marginal buyer is. In the past, speculative traders set the tone. Today, industrial users, long-term investors, and sovereign entities are increasingly driving demand. These participants are not easily shaken out by volatility, nor are they sensitive to short-term price suppression. They care about continuity of supply, not daily price action. As Eric Sprott has repeatedly pointed out, paper silver only works as long as it is trusted. Once trust erodes, manipulation stops working, not because regulators intervene, but because the market simply refuses to cooperate. When a market transitions from being sentiment-driven to supply-driven, price control shifts from those who print contracts to those who control metal. The $300 silver math. The reason Eric Sprott's $300 silver call unsettles so many people is because the math behind it is uncomfortably simple. There are no exotic models, no heroic assumptions, and no requirement for speculative mania. It begins with gold, not silver. In a world of expanding sovereign debt, persistent inflation, and declining confidence in fiat currencies, gold returning to the $4,000 to $4,500 range is not an extreme scenario. It is a historically consistent response to monetary stress. Gold does not need to become overvalued for this to happen. It only needs to do what it has always done when currencies are being diluted faster than trust can be maintained. Once gold is framed correctly, silver's upside becomes a function of relationship rather than imagination. If gold trades at $4,500 and the gold-to-silver ratio simply returns to its long-term historical average of 15:1, silver prices mathematically resolve to $300 an ounce. That is not a projection pulled from thin air. It is a reversion to a ratio that governed monetary systems for thousands of years. Even more striking is that in every major silver bull market, the ratio did not stop neatly at 15:1. It overshot. In 1980 and again in 2011, silver briefly became more expensive relative to gold than historical norms, driven by panic, scarcity, and the sudden realization that available supply was far smaller than assumed. What makes this calculation even more compelling today is that the starting point is far more distorted than in prior cycles. Silver has been suppressed relative to gold for decades, not because it lacks demand, but because it was easier to financialize and short. The wider the distortion, the more violent the correction tends to be. Sprott's framework does not assume perfect conditions. It assumes stress. It assumes that markets eventually reconcile paper pricing with physical reality. When that reconciliation occurs, the move in silver is not gradual or polite. It is fast, disorderly, and driven by necessity rather than speculation. In that context, $300 silver is not a ceiling. It is the math catching up to a system that postponed reality for too long. What happens when silver reprices? When silver finally reprices, the most important change will not be the number on the screen, it will be the behavior of the market itself. Silver does not move like equities or cryptocurrencies, where price discovery is continuous and liquidity expands with interest. Silver moves in phases of denial followed by sudden recognition. For long periods, it appears stagnant and ignored, and then, almost without warning, it gaps higher as buyers realize that available supply is far smaller than assumed. At that moment, price stops being an opinion and becomes a mechanism for rationing a scarce material. The first visible impact of repricing will be on industrial users. Companies that rely on silver for solar panels, electronics, and advanced manufacturing will no longer view it as a cheap, replaceable input. They will compete aggressively to secure long-term supply, even at higher prices, because production delays are far more expensive than paying up for metal. This creates a feedback loop. Higher prices do not destroy demand, they reinforce it, as securing silver becomes a strategic priority rather than a cost optimization exercise. Investment demand then compounds the pressure, as investors recognize that industrial buyers cannot walk away from the market. As this dynamic unfolds, the structure of the market changes. Physical premiums rise, availability tightens, and paper prices begin to lag real-world transactions. Mining equities are re-rated as the market recalculates the value of in-ground ounces, particularly for companies with large, high-quality silver reserves. Most importantly, the psychology around silver flips. The question shifts from "is silver too expensive?" to "can I get it at all?" Historically, that psychological pivot is what marks the most powerful phase of a silver bull market. By the time the repricing is obvious to everyone, the largest gains have already occurred, because silver does not wait for consensus. At its core, this silver story is not really about targets, charts, or even the possibility of $300 an ounce. It is about trust, specifically, the erosion of trust in financial systems that rely on leverage, promises, and perpetual confidence to function. Silver has always played a unique role in this regard. Unlike most assets, it sits at the intersection of money and material. It cannot be created by policy, and it cannot be replaced easily by substitutes. When trust in paper systems weakens, silver doesn't argue. It exposes the gap between what exists on balance sheets and what exists in the real world. This is why silver moves differently from other markets during periods of stress. It doesn't respond to narratives. It responds to behavior. When investors no longer trust paper claims, they ask for delivery. When industrial users no longer trust just-in-time supply chains, they stockpile. When currencies lose purchasing power, people look for anchors that do not depend on credibility alone. Each of these decisions is rational on its own, but together they create a powerful signal. Confidence is shifting away from abstractions and back toward tangible reality. Silver becomes the messenger, not because it is fashionable, but because it is unavoidable. Eric Sprott's call matters in this context because it recognizes that markets ultimately clear at the point where trust meets necessity. Price is simply the language used to reconcile the two. When silver reprices, it will not be because investors suddenly became optimistic. It will be because the system could no longer sustain the mismatch between paper promises and physical truth. In that sense, silver is not forecasting the future. It is reporting on the present, long before most people are willing to listen. So the real question isn't whether silver can reach $300. The question is whether the current system can continue pretending that paper claims and physical reality are the same thing. Eric Sprott's thesis isn't a prediction of hype or euphoria. It's a warning about what happens when long-standing distortions finally correct. Markets don't adjust forever. They resolve. And when they do, the adjustment is rarely comfortable or gradual. If you found value in this breakdown, make sure you subscribe to the channel. This is where we focus on structural shifts, not headlines, on what's changing beneath the surface before it becomes obvious to everyone else. Let me know in the comments. Do you believe the gold-to-silver ratio returns to 15:1, or does this cycle go even further? And if you want the next video, we'll go deeper into the mechanics most people still ignore, COMEX inventories, China's role in silver pricing, and why mining equities may be the most asymmetric part of this entire setup. Because by the time silver is trending everywhere, the most important decisions will already have been made.